Okay, welcome everyone to this First Intuition Masterclass webinar on the fascinating and mysterious subject of accounting for deferred tax under IFRS. So thank you for those of you who've answered my opening poll question in the room there. So you can give us an indication of who you study with and what methods you study or you used to study. That would be much appreciated. Throughout this webinar, you'll be able to ask me questions. So if you want to type a question in the chat box, then you're more than welcome to do so. The webinar will run for approximately 45 minutes, and there will be some time at the end for you to ask me some questions. So it's probably best maybe to ask your questions at the end, but please feel free to ask questions as we go through. Okay, I'm just going to move it into a slightly different layout now, and we'll make a start on the session. So welcome everyone. I guess first of all, before we start, I should introduce myself. My name is Sam Ackland, and I'm a tutor at First Intuition, specialising in financial reporting and taxation subjects. And before joining First Intuition, I spent 10 years working in the corporate tax function at KPMG in London, and I specialised in accounting for income taxes under IFRS, US GAAP and UK GAAP. So deferred tax is my favourite subject of all the accounting subjects. So we've got lots of useful information coming up for you. Now, before we make a start, I just wanted to ask you all a question. So you should be able to see coming into your screen now, there is a poll, and you need to tell me on a scale of 1 to 10, 10 being very confident and 1 being you have no idea what to do. I would like you to indicate as to how confident you are about deferred tax as a topic. I appreciate some of you might be studying ACCA FR, you might be doing SBR, you might be doing CMREF 2. Maybe you're doing ICAW, FAR or CR. So it could be various subjects that are being tested on deferred tax. But if you could give me a bit of an indication as to how confident you feel on this subject, that would be much appreciated. Okay, so I'm getting the results in now, and I think you can see on screen that most people are around about the middle there, so around about maybe a 4, 5, 6, quite a lot of people at a 3. So maybe, well, I hope that this session will increase your confidence on this topic. So what we will do is we'll get into some technical content and give you some simple examples really of deferred tax in action. And later in the session, we might get onto some technical topics that kind of are applicable to ACCA SBR only and maybe ICAW-CR, but we'll start with the most common examples of deferred tax and tax accounting. Okay, thank you very much for answering that poll. I'll hide that away so that we can move on into the session. It'd be helpful as well for you to indicate what exam paper you are studying for. So if you could have a look at the question that I've got there. So it seems like we've got lots of ACCA students in the room, either doing SBR or FR. Excellent. So as I say, most of our topics today will be applicable to both. There might be a few topics that will be applicable to SBR only, but depends how much we get through in this session. Okay, thank you very much for answering that poll. Let's move that off the screen and we will go into our session for today. So first of all, I guess just as a quick outline and introduction, you've got my contact details on screen there. So if you do get any questions about this session, or I guess if you're a First Intuition student, if you have any questions about the subjects you're studying where deferred tax comes up, you can contact me. My email address and phone number are on screen there. I'll also just make a note that you can see that there's a downloads box at the top of the screen, and that has the slides that I'm going to be using today. So if you want to download a copy of these slides, there are probably some slides that we won't have time to cover in today's session that you might find helpful on some other subjects, particularly I think if you're studying for SBR. So you're welcome to download those slides. Okay, well, let's move into our main layout then and make a start on today's session. Now, if you want to as well, you can make my slides full screen. So if you don't want to see my face and you need maybe a bigger area to view your screen, if you're not viewing on a particularly large screen, then you can make the slides that I've got full screen there if you want to. Okay, so what is deferred tax? I mentioned at the start, it's a bit of a mysterious subject. We know what current tax is. Current tax is simply the tax that we're going to pay to HMRC for the period. So we work out an estimate for the period and that will be our liability. Exactly how much, let's say, we will pay HMRC, albeit, of course, it's going to be an estimate at that stage. Deferred tax, though, is a bit more of a difficult concept to grasp. Now, we've got a definition here that it's the accruals concept applied to the tax expense. So we're going to match the tax effects of a transaction to their accounting impact. So this is something we'll come back to time and time again here, matching the tax effects of a transaction to the accounting impact. Now, first of all, I'm going to run through a little example of why we need deferred tax. So why can't we just stick with current tax? It'd be a lot easier. Why do we need deferred tax in our accounts? Well, we've got a company here, the FFC Limited, and it's buying a non-current asset for $1,000. And we're told it has a useful life of 5 years. The tax depreciation, or what you might know as capital allowances, the tax depreciation is at 100% in year one. Now, if you look at this schedule on the slide now, you can see a few things here. The first thing you can see is the accounting carrying amount of the asset. So we buy an asset in year one. You can see that we're depreciating it over its useful life of 5 years. So the carrying amount in year one is 800, and over the 5 years, of course, the carrying amount goes down to zero because we gradually depreciate the asset over its useful economic life. You can also see what's known as the tax written down value here, and the tax written down value, we can see, well, it ends up being zero after year one. Remember, we said tax depreciation is 100% in year one. So you can see that depreciation of 100% for tax purposes, the capital allowances that we sometimes call it, means that after year one, my tax written down value, so the tax value of the asset, if you like, is actually zero. The next thing that you can see in this schedule is a corporate income tax computation. So this is, I guess, going to our taxation studies and our maybe you've studied ACCA taxation, or maybe even advanced taxation. But we have to do a tax computation, and we start with, let's say, profit before tax, and we've just made up a figure here of 1,000. Okay, so let's assume the profit before tax is 1,000. Now, of course, the depreciation is not allowed for tax purposes, so we add it back. But instead, we deduct the capital allowances. Now, you can see what that results in is taxable profits that are really low in the first year and that are higher in subsequent years. Because, of course, what we're doing is disallowing the depreciation, claiming the capital allowances instead. And what that means, of course, is that you've got a situation where your capital allowances that happen all in year one reduce your taxable profits in year one. Okay, so we've done a corporate tax computation, and of course, it's quite straightforward to work out how much tax we're going to have to pay. Let's assume the tax rate is a nice straightforward 20%. And you can see I take my taxable profits, I times it by my tax rate. It means that I've got 40 of tax to pay in year one, but then you can see that in years 2, 3, 4, and 5, I have 240 of tax to pay. That's because of the difference between when the depreciation happens and when the capital allowances happen. Okay, so we have this concept, don't we, of the accounting carrying amount, the tax written down value. We do our corporate income tax calculation, and we get to the current tax expense in our accounts. Let's have a look at taking this example a little bit further. So we've got those numbers there that we were familiar with from the last slide. And you can see that in total, the depreciation over the 5 years is, of course, 1,000. Okay, so for the accounting carrying value, the depreciation is 1,000. And that makes sense, of course, because this is an asset that we are writing off or we are depreciating over 5 years. The capital allowances also total 1,000, albeit they all happen, of course, in year 1. So all of the capital allowances happen in year 1. So you can see what we have here is what's known as a temporary difference. In total, there is 1,000 of accounting depreciation and 1,000 of tax depreciation. Any difference between the accounting carrying amount and the tax written down value of the asset is only temporary. You can see but by the time I get to the end of year 5, the carrying amount of the asset is 0 and the tax written down value of the asset is 0. So they both match after the end of year 5, but obviously before that there is what's known as a temporary difference between those two values. You can also see here that over the 5 years, the accounting profits total 5,000. Now, we made up a profit before tax of 1,000 every year, and of course, for 5 years, that is $5,000. What about the taxable profits, though? Well, we saw that we had very low taxable profits in year 1, but they went up in years 2, 3, 4, and 5. Now, once we total the 5 years, of course, we have 5,000 of taxable profits, which is the same as the accounting profits. Now that, of course, makes sense because of what we saw with the asset. We have a total of 1,000 of depreciation. We have a total of 1,000 of capital allowances over the 5 years. So there is actually no difference over 5 years between the profits in the accounts, the profit before tax, and the taxable profits that we put in our tax computation. They are the same number in total over 5 years. Okay, so what about the tax expense then, the current tax at 20%? Well, we of course had a very low current tax expense in year 1. It increased therefore in years 2, 3, 4, and 5. And you can see that over the 5 years, the current tax total adds up to 1,000. Okay, so if you add up the current tax expense for years 1 to 5, you get to 1,000, which happens to be, of course, 20% of the profits of 5,000. So that's what we would expect if the tax rate is 1,000. But here's where we have a problem. Okay, so the tax expense each year does not match the accounting profits. Remember, the accounting profits we made up as 1,000 every year. Okay, so we had 1,000 every year of accounting profits. But when you look at the tax expense is really low in year 1 and then increases in the future years. So the tax expense does not match the profits. The profits happen evenly over the period, but the tax expense happens unevenly over the period. So this is why we need deferred tax. We need to make sure that the tax expense matches the accounting profit, and it doesn't at the moment. So along comes deferred tax and fixes things for us. So let's have a look at how we work out the deferred tax situation in relation to this particular asset. Now, I've just summarized at the top there the carrying amount of the asset. That's the value on your statement of financial position. We saw we bought it for 1,000. It's depreciated over 5 years, so it goes down in terms of its carrying value by 200 every year. Contrast that to number B there, the tax written down value, which of course starts at 0 because we claim our capital allowances all in year 1. So let's explain what's happening here. We have this temporary difference. The temporary difference is the difference between A, the carrying amount of the asset on my statement of financial position, and B, the tax written down value of the asset. Okay, so that's the value of the asset, if you like, for tax purposes. So we have this temporary difference, A minus B there, and it starts off, of course, at 800, but eventually it goes down to 0. We saw that in year 5, the carrying amount of the asset and the tax written down value of the asset will be the same, so there will be no temporary difference. So the temporary difference starts at 800 and it gradually declines over those 5 years. What do I do next? Well, I take that temporary difference and I times it by the tax rate. The tax rate is 20% in my made up example. And so if we take that temporary difference and times it by the tax rate, we get to the deferred tax provision that is needed. So in year 1, you can see that I need a deferred tax provision in my accounts of 160. Okay, so how do I put that 160 in my accounts? Well, I haven't got any deferred tax in my accounts at the moment. So what I do is I debit tax expense and credit deferred tax liability. Notice what that means the total tax expense is in this period. I've now got 160 as a tax expense arising from this deferred tax. And I had, remember, this very low current tax expense of 40. So the total tax expense is now I think my connection dropped out for some reason, so I think I should be back now, but yeah, apologies for that one. I'm not sure what happened there. Some gremlins in the system, but hopefully you can now see my screen. Okay, so why do we need this situation with deferred tax then? Well, we said we've got that extra tax expense coming in year 1. Look what happens in year 2. Okay, in year 2, you have there, in year 2, the temporary difference has gone down to 600. Okay, so the temporary difference has gone down to 600. If I times that by 20%, which is my tax rate, of course, what happens is I get to deferred tax that's needed now of 120. That means if I started with a deferred tax provision of 160, I now need to reduce it to 120. So I put this difference in of minus 40. Okay, so I put this difference in of minus 40. That is reducing my deferred tax liability by 40. And so to reduce my deferred tax liability, I debit my deferred tax liability and I credit my tax expense. Okay, Barbara, the carrying value in year 2 is simply with 2 years worth of depreciation. So 200 of depreciation in year 1, 200 of depreciation in year 2. So if I started with a value of 1,000, I've now got 600. Okay, so we reduce our deferred tax liability in year 2. You can see that has the effect in year 2 of taking my current tax expense of 240 and reducing it by 40. And again, it means that my total tax expense in year 2, okay, so my total tax expense in year 2 is 200. And you can see the total tax expense is 200 in each year. Okay, so in each year, the total tax expense is 200. Gagan, the current tax expense was taken from the previous slide. So we did in the previous slide calculate what the current tax was based on the taxable profits. So if you look at your previous slides, if you download them, you'll be able to see that. Okay, so what have we done? We have solved our problem. We have matched our tax expense to our accounting profit. Notice we have now 1,000 of tax expense in total, which is exactly what we had before, but we've now spread it evenly over the 5 years, such that we have a tax expense of 200 every year that matches our accounting profit. Our accounting profit we made up, I think, was a figure of 1,000, and we get to what's known as our effective tax rate of 20%, so 200 tax expense every year. Okay, so that's why we need deferred tax. We need to use these temporary differences such that we can match our tax expense to our accounting profits. That example that I've just gone through, and obviously you might need to have a look through the slides in your own time to trace through these figures, but that example that I've just gone through is an example of what we call accelerated capital allowances. So it's a difference between the tax allowances that we get for an asset and its accounting carrying amount. Emma, if HMRC changed the amount of tax, would that impact the accounts? Yes, it would. Okay, so we might go on to what tax rate we should use, but yes, there is an issue around changing tax rates that would need to be reflected in our accounts. Okay, so we've done a practical example. We've shown, I think, why we need deferred tax. I'm just going to step back a bit now and look at the theory of deferred tax. Now, the theory takes our assets on our statement of financial position and compares our carrying amount. We just looked at an asset that had a carrying amount on the statement of financial position, and it compares it to what's known as the tax base. Now, we've got the definition of the tax base there. It's essentially the amount that will be deductible in future in relation to this asset. So I guess particularly for those of you that were doing SBR, I would make sure that you do learn this tax rate. Barbara, you will not see, no, not in financial reporting exams, very unlikely that you would see any prorated tax percentage. Remember, FR and SBR are not tax exams, they are accounting exams, so they'll tell you the tax rules in the question. Okay, what about a liability? Well, we get a liability on our statement of financial position and we have a carrying amount for that liability. What is the tax base of the liability? Again, particularly for those studying SBR, a definition that you need to Okay, apologies for the disruption in my connection. I have had a bit of an issue with my internet connection at my home, so apologies for that, and that's why I dropped off. I can see that lots of people have stayed in the room, so thank you very much for bearing with us. We will continue regardless. If things do drop off again, what we might do is reschedule this session for another time, or we can send you round a recording. So apologies for the disruption, but we will start where we left off and maybe we can run just up until 2 o'clock, just not to keep you any longer than we were planning. So with a liability on the statement of financial position, then you've got the carrying amount, you compare it to the tax base, and we get to the deferred tax situation. An example of a liability on the statement of financial position, well, it can be anything. It could be a loan, it could be a lease liability, anything that's on your statement of financial position as a liability. Okay, there's also a rule you can learn, and this is in your SBR notes if you're studying for SBR, that essentially if you just plug the figures into this working, you will get to the answer. And we've done that with, let's say, an example of an asset that has a carrying amount of $1,000. We've deducted the tax base from that asset. We get a positive number as our temporary difference. And I change the sign around and times it by the tax rate of 20%. And that essentially means that I have a deferred tax liability here of $100. So this is exactly what we did in the first example. We had a carrying amount of an asset that was higher than its tax base, and it led to a temporary difference. We times the temporary difference by the tax rate, and that gets us to our deferred tax asset or liability. In this case, of course, liability. And that comes from those rules that I've shown at the bottom of the screen there. These are rules that you can learn that will always work in terms of your calculation. And we dealt with the first one of those rules. So where the carrying amount of the asset was greater than the tax base, we ended up with a deferred tax liability. If you flip anything around, in that equation, if you like, you'll end up with the opposite result. Okay, so I'm not going to go through that in detail here because I want to focus on a few more examples, but this is a rule that you can learn and it will kind of always get you the number. In terms of how I worked out the tax base of 500, well, I just made it up, okay? So it might be that, let's say, this is year one and we get, let's say, 50% capital allowances in year one. So you'll be told the tax rules or you'll be told the tax base to work out what we think the value for tax purposes are. I guess in my example that I did earlier, the tax base turned out to be 0 right from the start. Okay, so those are rules that you can learn in terms of doing the numbers on these. Let's have a look though at some more examples of assets and liabilities that can give you deferred tax implications. Okay, so we're thinking about deferred tax. Deferred tax is essentially accounting for the future tax effects of transactions. And if I have extra tax to pay in the future, which is the example that we did first thing this afternoon, if I have extra tax to pay in the future, that will result in what's known as a taxable temporary difference, and that will give me a deferred tax liability. To put the deferred tax liability in my accounts, I debit my tax expense in the profit and loss, and I credit my deferred tax liability on the statement of financial position. And you have to always recognize deferred tax liabilities. In the green arrows there at the bottom, we've got some good news. Maybe we've got a tax reduction in the future. Okay, so rather than paying more tax in the future, we're actually going to pay less tax in the future. This is what's known as a deductible temporary difference. Okay, so a deductible temporary difference, and it leads instead to a deferred tax asset. You debit deferred tax asset on your statement of financial position, and you credit your tax expense. Okay, so you credit your tax expense. And I've put there recognize question mark. With a deferred tax asset, we have conditions as to whether we recognize it or not. And essentially that condition is that you must have future taxable profits against which we can recognize this asset. Okay, so we must have future taxable profits against which we will get that tax reduction in the future. Okay, right then, let's move on then to some further deferred tax examples. So what have we got in terms of further deferred tax examples? Well, there's a few common ones on screen there. We will deal first of all with revaluations of assets. We'll also have a look at tax losses. And if we get time, we can have a quick look at pensions, which will be applicable to your SBR students only. And also we'll look at share-based payments, which also is applicable for SBR students only. So we'll do the more common ones first, and then if we've still got some time coming up to 2 o'clock, then we will run through those additional examples. Okay, let's first of all have a look at revaluations of non-current assets. Now, what happens in a revaluation of a non-current asset, of course, is that the carrying amount of the asset increases. So what happens is I have an asset on my statement of financial position and I decide to, let's say, revalue it, or I'm adopting the revaluation basis. And so the carrying amount of the asset goes up. Now that leads to, or that will result in, tax to pay in future when you sell the asset. Now it's not the revaluation, of course, that's led to the tax that you will pay in the future, but we are, of course, recognizing the value of the asset in the accounts rather than, let's say, its cost. That therefore leads to a taxable temporary difference, i.e. more tax to pay in the future, and so we have a deferred tax liability. You could go back to your rules that we went through in terms of the theory. Your asset carrying amount has gone up, your tax base has stayed the same, and therefore this leads to a deferred tax liability. Note the double entry for this one. Instead of debiting the tax expense, you will debit a revaluation surplus. Okay, so instead of debiting the tax expense, you will debit a revaluation surplus. So debit revaluation surplus, credit deferred tax liability. Let's run through some basic numbers then. I have an asset and it's revalued from its carrying amount of $5,000 to $10,000. That will give me, of course, a revaluation surplus in my accounts of $5,000. I have to match the tax effects of this to the accounting impact. So I have this deferred tax liability. It reflects the tax that I'm going to pay in future when I sell the asset. Okay, so it reflects the tax that I'm going to pay in future when I sell the asset. Now, how much tax will I pay? Well, let's say that the tax rate is 20%, and we've increased the value of the asset by 5,000. Of course, that will lead to a tax liability of 1,000. Okay, the accounting impact of this transaction was a revaluation surplus of 5,000, and therefore what we'll do is we will do that double entry that I have on the right-hand side of the screen there. We will debit revaluation surplus and credit deferred tax liability. Okay, so we'll debit revaluation surplus and credit deferred tax liability. Okay, so the balance in my revaluation surplus is now 5,000 minus the 1,000 debit for the deferred tax, which makes it 4,000. Now, if you think about this, this is what will happen for tax purposes. You will sell the asset, you'll, let's say, make a gain of 5,000 if we, let's say, sold it immediately, but you have to pay tax on that gain. So the amount you'll end up with won't be 5,000, it will actually be 4,000. So the profit that you end up with will be 4,000 after the tax that you pay. So that's why we have deferred tax going to the revaluation surplus there. I've just had a question. Yes, this session is being recorded, so we will send out the link to the recording for those of you that might need to drop off early. Okay, now this applies irrespective of the intention to sell the asset. So I don't need to intend to sell this asset at any point. I just simply compare the carrying amount with the tax base and I end up with a deferred tax liability. Okay, so it's very similar, I guess, to the first example that we saw on accelerated capital allowances. Your carrying amount of the asset is higher than your tax base. And because the carrying amount is higher than the tax base, the carrying amount, remember, has increased by the revaluation surplus. You are going to have a deferred tax liability. What if the asset is not sold? Well, it doesn't matter if the asset is not sold. As we said, it applies irrespective of the intention to sell. Obviously, the temporary difference might change in future as the valuation of the asset changes in future. Okay, so you would just have to reflect any changes in your revaluation of the asset through deferred tax as well. Okay, now if we're doing group accounts, it's actually the same theory for fair value adjustments on consolidation. We'll have a look at, or there are some information in the slides that we won't get time to go through today, but there are some examples of revaluing an asset to fair value on acquisition, because that's what we have to do in our accounts, and it ends up creating a deferred tax liability, which affects your goodwill calculation. Okay, a very simple example now of deferred tax and tax losses. Let's have a look at this one. Well, if I've got tax losses, I have a tax reduction in the future when I use the loss. Okay, so my tax will reduce in future when I get to use this tax loss. This gives me what's known as a deductible temporary difference, and I therefore have a deferred tax asset in my accounts for this one. So remember, when you're thinking about whether it's a deferred tax asset or liability, you can think, well, in future, am I going to have to pay more tax or less tax? Well, if I've got a tax loss, I'll pay less tax in future. The double entry is debit deferred tax asset and credit tax expense. We've got an example here. Let's say I've got tax losses carried forward of $1,000. The tax saving in the future, assuming a tax rate of 20%, will be $200. And I recognize this to the extent that is probable future taxable profits will be available to use the tax loss against. So you might remember from your taxation studies that a loss gets carried forward into the future, and if you can't use it, it carries on getting carried forward. So we need to make sure in the accounts that if we recognize a deferred tax asset, we do this only to the extent that there are future taxable profits that we can use the loss against. Okay, so that's a very basic, I guess, example of deferred tax on tax losses, the fact that we have a reduction in tax in the future that will lead to a deferred tax asset. Right then, I appreciate I'm coming up to the time we said we would stop and take questions, but if it's okay with you, we'll run for about another 10 to 15 minutes just to account for the short break that we had in the middle, the unscheduled break, and I can take questions at the end of that, but obviously the recording will be available to you, those of you who don't who can't stick around any longer. Okay, when would tax be non-probable? Well, we're just saying that we need a decent budget from the, whoever's forecasting the tax position for the company. We need a budget that says that they are going to make probable future taxable profits. So there's a greater than 50% chance that they will use the tax losses. The recording link will be sent round, I think, I'm not sure whether it will be sent round today, but it will be sent round soon after class. Okay, let's have a look at this example then on pension deficits. Okay, so this will be applicable to SBR only because you do pension accounting, of course, at SBR. But with a pension deficit, what usually happens is we have a tax reduction in the future. You have a liability on your statement of financial position, and the tax deduction for that liability is only going to come when you pay that liability. So most territories around the world only give you a tax deduction for pensions when you actually pay the liability. So we have a future reduction in our tax bill when we pay the liability. This leads to, therefore, a deductible temporary difference and results in a deferred tax asset. Now, you can appreciate I'd get to the opposite situation if I had a pension asset on my statement of financial position, but I think this one's maybe a bit more intuitive in terms of understanding it. And to be honest, whoever sees a pension asset on the statement of financial position in real life? Okay, so what do I do in my accounts? Well, I debit deferred tax asset, I credit tax expense, and I might also credit other comprehensive income. Okay, why do we do that? Well, let's have a quick look at an example. Let's say I've got a pension deficit or net liability on my statement of financial position. So the asset minus the liability is $5,000. I get tax relief when I pay the liability. So any expense in my profit and loss account is disallowed for tax purposes, and instead I get a tax deduction when I actually pay the liability. So what's the theory of this then? Well, obviously the liability carrying amount in the accounts is $5,000. The tax base, well, if you go back to your definition of the tax base that we looked at in the theory section earlier, we said that the tax base is the carrying amount less any future tax deductions. Okay, so the tax base is the carrying amount less any future tax deductions. So we start with the 5,000 carrying amount and we say, well, I get tax deductions when I pay the liability. So that means I think my carrying amount will be 5,000 minus 5,000, which is 0. So my tax base is 5,000 minus 5,000, which is 0. So the liabilities carrying amount is 5,000. The liabilities tax base is 0. We have in this situation, therefore, a liability where the carrying amount is greater than the tax base. that will lead to a deferred tax asset according to our rules that we will need to learn. And again, we have to look at matching the tax profits and loss. So match the tax to the profit and loss expense. So to the extent, of course, that the accounting is not going through profit and loss, you might have had, let's say, half of the deficit, half of the liability arising through profit and loss, and maybe half of it comes about from your remeasurement gains and losses. And the remeasurement gains and losses, of course, go through OCI. So in that case, we need to put half of the tax expense through the profit and loss and half through OCI. So that's where we might credit tax expense with some of the amount and credit OCI with some of it. All about, remember, matching the tax to where the accounts have happened. If I've got my deficit, my liability of 5,000, and it's been created through the profit and loss account, well, we'll put the tax there as well. But if it's been created through other comprehensive income, you'll put the tax through other comprehensive income. Okay, so that's a tough one on pensions. And to be honest, you would probably do well to use your rules to work out whether we have a deferred tax asset or liability. But I think it's easy to think about the pension liability as getting a tax deduction in future when you pay it. So that circumstance leads to a deferred tax asset. Of course, if you're in any opposite circumstance to that, you would have a deferred tax liability. Right, I think we'll do one further example, which is applicable to your SBR studies. So those of you who are doing FR, you have this fun to come. What about share-based payments? Well, very similar really, in that we have a tax deduction in future, not now. So when the share-based payment, when the share option is exercised, that's when you get your tax relief. So deductible temporary difference leads to a deferred tax asset. Debit deferred tax asset, credit tax expense, potentially credit equity as well, because the maximum amount that you can put in your tax expense is limited to the cumulative profit and loss expense that's gone through in relation to the share-based payment times the tax rate. So again, this is all about matching the tax consequences to the accounting transactions. Okay, so to go through this in a bit more detail, this will be an equity settled share-based payment, let's say. So no asset or liability on the statement of financial position. We get an expense for tax purposes when the option is exercised. Let's say that expense for tax purposes is $5,000. The carrying amount is nil. The tax base is, well, it's sort of negative $5,000 because we start with the carrying amount and we deduct the future tax deduction. So the carrying amount is nil and the tax base is negative 5,000. This means that the carrying amount is actually bigger than the tax base because remember we said the tax base was negative. So we get to a deferred tax asset. Now I wouldn't worry too much about that theory. If you can talk sensibly in SBR about what temporary differences are and how they arise, then we can then come to the conclusion that because we got this future tax deduction on the share-based payments, we have a deferred tax asset. As I've said there, limit the credit to the tax expense to the tax rate multiplied by the cumulative profit and loss expense. So we're doing this matching concept. How much of my share-based payment expense has gone through the profit and loss account? If I times that by the tax rate, that's the maximum amount that I can put through the profit and loss account in terms of deferred tax effects. Okay, so those are 4 common examples. Accelerated capital allowances, which you'll deal with at FR and SBR. That's the first example that we went through in quite a lot of detail to show you about the need for deferred tax. We then dealt with revaluations. That's a similar concept really of just looking at a non-current asset where the carrying amount of the asset has gone up. Just be careful, obviously, with those you have to put through the deferred tax through the revaluation surplus. We then looked at tax losses, which is a relatively straightforward one in terms of a future tax reduction. Pensions and share-based payments, something that you might see at SBR. Okay, so I think what we'll do there is I'll wrap up. Now, I'm just going to give you a few other interesting facts, as it were, about deferred tax, if there is such a thing. What have we got about interesting facts? Well, the deferred tax position on the statement of financial position, a deferred tax liability is always a non-current liability. Okay, so it's always a non-current liability. Don't know why, that's just what the accounting standard says. We talked about the tax rate earlier. So what tax rate do I use? Well, you have to use the tax rate that's been substantively enacted at the year end. And there's all sorts of complexities around this, but essentially, if we have the tax rate that's been changed, it must have gone through the House of Commons. We must have basically had a law passed that changes the tax rate, so that we will then change our deferred tax calculations. In the middle there, I've talked about offsetting assets and liabilities. Maybe you've got some deferred tax assets and some deferred tax liabilities. Can you offset them? Well, you can, but only where there is a legal right to offset and you will settle these liabilities net. So, if they all relate to corporation tax and they all relate to, let's say, one country, the UK, we'd expect that you would offset them because, you can offset deductions and taxable amounts in a UK corporation tax computation. But if they relate to different countries, well, you'd have to keep them separate because you can't, let's say, offset a loss in France against, let's say, a profit in the UK. What about deferred tax assets? Well, we've had a look at that. They are only recognised where there is future taxable profits expected. So we've got to be careful on the recognition of deferred tax assets. Now, in your slides, I've just outlined a few further examples that relate to groups that might be useful for your SBR studies. So please do look over those in your own time and let me know if you have any questions on those. Right, apologies once again for the slight disruption earlier, but we will wrap up now, and I think that's a good time to just summarise and take some questions. So, in summary, deferred tax arises on temporary differences between the accounting carrying amount of an asset or liability and its tax base. Okay, so always on temporary differences between the carrying amount and its tax base. It seeks to match the tax effects of the transaction to the accounting input. So this is all good things that you could say in a deferred tax question. Let's say in SBR where you've got to write about things, it's going to pick up credit. Do learn the definitions of the tax base, particularly if you're studying SBR. At FR level, you'll more be looking at the calculations. Can you work out what the calculations are? And the pro forma that we've given you earlier will help with that. So do as well learn that pro forma for whether you've got a deferred tax asset or liability, so what the outcome is in that one. So do have a look at that pro forma and learn those. SEPI, if you download the slides that are in the download box there, you will get access to all of those extra examples on groups. Okay, so you'll get access to those in the downloads box. Okay. Right, fire away then. I appreciate that some of you may need to get back to work or get outside in the sunshine, given it's nearly 2 o'clock. But does anyone have any questions based on what we've gone through today? Actually, what I do want to do is just first of all ask you this question again, okay, to see if the results are any different. Have we got any more confident, do we think, about this topic area? So what deferred tax is, how it works, what the point of it is. I think that first example that I went through is crucial there and may well, of course, be something that you'll want to just work through on your own and read through on your own after you've downloaded the slides. Okay, well, this is quite reasonably encouraging. So we've got more clustered around the sort of 6 or 7 mark, when before we were maybe clustered around the sort of 3, 4, 5 mark. So hopefully I've helped a little bit in terms of the deferred tax in terms of this topic. So thank you very much for filling in that survey. So Amy has a question. In SBR, for a fair value adjustment, should you automatically account for the deferred tax movement, or do you have to be told to do it? Good question, Amy. So sometimes the question will just say simply ignore the tax effects. Often they say that in questions. Disappointing, obviously, if you haven't got to deal with the tax effects, but often they do say ignore the tax effects of this transaction. But if they don't say it, yes, absolutely. Don't go to town on it and write loads on it, but I would, just note that there's likely to be deferred tax implications of this because the carrying amount of an asset has gone up, and you could put that through your calculations as well. That will definitely get credit there. Okay, so Amy, just be careful on the wording of the question, whether it asks you specifically to deal with or not deal with any tax effects, but otherwise, yes, take it into consideration. It will be there for picking up some nice extra marks. Okay, has anyone else got any questions before we wrap up today? Okay, do fire away if you've got any questions. I'll be sticking around for the next few minutes if you want to ask some. Hopefully that's been useful to you and you've got those slides to go away with, and you've got my contact details on screen there if you do have any questions that arise on deferred tax. I'd be happy to field any for you. Okay, well, thank you very much, everyone, and thank you for bearing with me during the slight technical issue that we had midway through the session. Maybe you got a nice little break halfway through, and look at that, we finished just on time. So hopefully that wasn't too disruptive for you. And enjoy the rest of your day. Get out there, enjoy the sunshine at some point today, and hopefully I will see you on First Intuition courses in the future. Best of luck for all of your exams that you've got coming up, and yeah, all the best for the rest of the week.